Well, welcome to the program today, Michael. It's great to have you.
Hi, Simon. How are you?
Surviving, I think, is the best way to describe the current situation.
Yeah, I think that is. I don't even know if we're surviving, to be honest, at the moment.
Well, yeah, it's hard going, isn't it? But let's start with economic outlook. And the Fed came out and made a statement that didn't seem so great. What are you hearing there?
Well, I think they most probably realigned a few things in people's minds and markets' sort of minds. And we've seen an interesting response to it in that last night we saw equity markets in the US drop by sort of 5 to 6.5%. And I think they've come out and they've, I think, put a bit of a reality check around the exuberance we've seen in particularly equity markets, but some other asset markets. So they're now forecasting real GDP in the US this year to fall by about 6.5%, which actually is not, that's more optimistic than the OECD, who have got it falling by about 7.3%. And they're forecasting a rebound of 5% next year and 3.5% in 2022. But when you look at that over a 3-year period, it means very little growth over that 3-year period. And in fact, the OECD are nearly 1% lower for their 2021 forecast for GDP growth in the US at only 4.1%. And they're saying if they get a second wave of COVID, the 2020 result could be actually worse and see real GDP fall by at least 8.5%. And I think if you look at unemployment, we saw a 50-year low in unemployment, around 3.7% in February this year. The Fed are now forecasting for Q4 this year 9.5%, only falling to 6.5% next year and remaining at 5.5% in 2022. So you're still a long way from that February 2020 low of 3.7%. So I think when you look at that versus the market's pricing in a V-shaped recovery, as I said, I think there's a bit of a reality check if you believe those forecasts.
And then you've also got not a lot of guidance coming out for companies around their earnings.
No, a lot of companies have actually withdrawn guidance, which sort of is quite fascinating how I'm not quite sure how people buying shares at these levels are actually valuing them, because if companies can't give you guidance, I think that's a bit of a concern in itself. But I think it's a reflection of just the uncertainty that we're facing at the moment. And we saw in the Australian market, briefly we saw the price earnings ratios trading back above 20, which is pretty well where they were pre-COVID, and quite a way above their sort of longer term average of, I guess, between 16 and 18. So I think what we've seen is that risk appetite really elevate in the last sort of 4 to 6 weeks. But I think now, certainly last night, we saw the US equity market drop by between 5 and 6.5%. Maybe they're starting to digest the forecast from the Fed and the OECD and think that, some of these elevated or multiple earnings multiples, when companies themselves are struggling to actually give you guidance, I think people are maybe now going to take a step back and say, we sort of gone a bit too far. I mean, if you look at the S&P 500, it jumped from its March lows on 23rd of March, 47.5%. Now, admittedly, it's sold off a long way, but it did get to within less than 5% of its record high in late February. So that to me is a market that's priced to perfection. It's basically saying V-shaped recovery, and we're not really factoring anything going wrong with that. Maybe with the increase in COVID cases we're starting to see in pockets in the US and the updated forecasts from the US Fed and the OECD, I think people are now taking a breather and stepping back and maybe re-evaluating.
And there's not really much that can happen on the interest rate side. I mean, a lot have gone negative, but that's kind of fairly stable, is it?
Well, it has been, but interestingly, when I think the RBNZ and the Bank of England didn't rule out negative interest rates, what we did see is that bond yield differentials moved quite quickly in favour of, say, Australia, And we saw at one point, I think, our 10-year bond yielding about 25 basis points higher than the 10-year New Zealand bond. Now, that's narrowed to about 10 basis points. But what that saw was some capital flows into interest rate related products into Australia, which you wouldn't believe possible with a cash rate of 0.25%. But whilst the cash rates are the same, we did see quite a movement in bond differentials, and that was one of the drivers for the Aussie dollar. The other thing we saw is, I think most people thought the 10-year bond in Australia would trade between maybe 100 basis points, but we did actually see it jump to 1.1% a few days ago, and that was when the equity markets were on their highs. But we've now back, with that sell-off last night, we're now back at about 0.92%, which is most probably back to where it really more should be trading. I think 1.1% was most probably a little bit high given the risks we've got at the moment. So there has been certainly movement in the differentials and a little bit of movement in just the outright bond yields. But again, I think as markets start to maybe reprice equities a bit and the risk reward balances, I think we'll see the longer dated yields maybe drifting a little bit lower.
And what about on the FX side of things? It's been a bit of a V-shape for the Aussie dollar, and I guess the opposite for the US.
Well, I think I've been sacked as an FX picker after the most recent run up. It's like I was thinking to myself, I think I've traded currencies for 35 years, but the last few weeks I'm thinking it's like I've never done a deal in my life. I think, as I said last time, the Aussie dollar, I didn't see it breaking back through that 66.60 to 66.80 level. That was such a major support on the way down last year. And then we did have a rebound. When the US did their first rate cut, the Aussie dollar rebounded back to, up to 66.80 and then dropped sharply. I thought that would hold the rally. When it broke 66.80, from a technical perspective, the Aussie dollar was going to go up. And it coincided, as I said, with a movement in bond differentials in favour of Australia against a lot of our major sort of trading partners. It also corresponded with us having record trade surpluses, and iron ore futures are still around $100 a metric tonne, a lot higher than we forecast. And Australia's been able to leverage, I guess, a bit of Brazilian misery with shutdowns in some of the iron ore production due to COVID. And Australia's been a beneficiary of that. So it had, and I guess the fact that our COVID infection rates declined so much quicker than expected, we had a lot of headwinds behind the Aussie dollar. We also had the US dollar weakening a little bit. So there was a lot of technical buying and most probably a lot of stop losses, yours truly included, I suspect, above 66.80. Now, having said that, the Aussie did briefly trade above the January high. So we had a high in January around 70.40. We got up about 0.25% 2 nights ago when the US Fed started their updates. But today we're back down around 68.30. So again, as risk aversion sort of started to come back the last 2 nights, the Aussie dollar's come back with it. And I guess the other headwind for the Aussie dollar potentially, or maybe, it depends how it goes, is the China trade tensions. We've seen it with some meat and barley, and the most recent comments out of China around foreign students. And bear in mind that foreign students are Australia's 3rd largest export. But my view on that is that if you look at the trend in Chinese goods and services and trade, my view, and this really came out last year, that at some point there was going to be pressure, I think, on China to try and get students to study at home more than abroad, because the economic cost of people travelling and studying overseas is quite significant. And if your trade on goods is not where you want it or where it's previously been, you are going to look at the service sector and put some pressure on. So I think the timing of that, to me, is not that surprising. And I think China's concerned about outbound foreign students. is not really just Australia. I think that's a global thing. So my view on that is that it's something worth watching, though, because clearly we are very trade exposed to China. And if iron ore prices start to decline, as they're forecast to do, and we have an escalation of trade tensions, that's a clear headwind for the Aussie dollar.
Sorry.
We need to keep an eye on that.
What about on the commodity side of things? What are you seeing there?
Sorry,
Sorry.
I've just got something.
I've got a meeting at 9:50.
Sorry, can you just ask that again?
What are you seeing on the commodity side of things, Michael?
Commodities. Look, it was interesting that gold held up remarkably well despite that increased risk appetite that took equities to within, in the US, 5% of their highs, and the Aussie dollar above 70 cents. I would have expected, if people were that upbeat about that V-shaped recovery, I would have thought gold would have pulled back more than it did. But it's remained incredibly resilient, which has been a bit of an anomaly for me, given it's a safe haven asset. Oil prices have had an amazingly strong recovery, but again, last night dropped about 8 or 9%. And again, if you look at oil prices, the Aussie dollar, the S&P, they're all V-shaped charts. If you have a look at any three of them, they've all got that V-shape. I think with oil, people again have to most probably, I think there's a bit of a reassessment now about, is demand going to be as strong as they were starting to factor in? And are the OPEC production costs, are they all going to hold? Are all the nations going to actually do what they've said they've done on production cuts? That's always an ongoing question with that alliance. So I think, again, if markets start to price in a bit more risk of wave 2 COVID, or maybe borders not opening up as quickly as we were thinking, oil prices, again, you'll get what you saw last night. On food commodities, they're still, certainly the ones I look at, wheat, corn, barley, soy meal, sugar, they're all still pretty weak. They're certainly a lot closer to the bottom end of their ranges. Base metals have recovered a little bit, or they had a reasonable recovery. Again, last few days they've started to pull back a bit. And I noticed that one of the banks put out something this morning on forward estimates for copper demand that were weaker than they expected. So we're starting, base metals again are most probably, I think everyone's sort of looking at these rallies and saying, where to from here? Have we gone too far, too fast? Do we just take a bit more time out, reassess, see what's, the trends look like, or how we think they're going to emerge from here? So, I think again with commodities, they're really going to reflect what we're seeing in other markets, that people are just going to step back, take a breather, and just reassess as to whether there's too much good news factored in some of these prices, or whether, and if that's the case, what I think you're going to see is some profit taking and markets pulling back a little bit.
Mm-hmm. So what's your best advice then for treasurers as to where they should be keeping their eyes over the next month?
Look, I think if you're an importer, you've seen great rallies in the Aussie against the Euro, Sterling, New Zealand, US. As I think we've been saying, average in. Don't put all your eggs in one basket. That was one thing I got right, because if I did that, I would have been buying way too many US dollars at lower levels. Certainly my recommendation has been to just average in, because the volatility and uncertainty is so great. I think there's a great opportunity on this Aussie rally for certainly importers that are not covered to take cover. My view in some of these previous podcasts is that we would see the Aussie back above 70 cents. So where I was wrong was not the longer term direction, but was the timing. I thought that was a Q4 or Q1 2021 story, Aussie above 70 cents, not Q2. So I think that in the short term, I think you use this Aussie rally, particularly in Q4 and maybe Q3, Q4 exposures as an importer. If you're an exporter, I think you You may well, I wouldn't surprise me to see a dip back and a retest of the Aussie back to sort of 67, 66, 80, those sorts of key levels. You most probably start again buying Aussie dollars down there. But if we see the Aussie back through that 66, 60, 80 level, well, then I think we're back in a neutral zone. And I think then you just have to tread quite lightly both ways. I think the other challenge for treasurers is that we are still going to get some longer dated maturity or yield volatility. We're not going to see a lot in the short end because the central banks are targeting, say in Australia, 3-year bonds at 25 basis points. But as I was talking about before, if you look at the 10-year bond market, that is still moving around, and that longer end of the curve where the central banks are not targeting. So I think treasurers and people with debt should be watching the long end very closely, because it's that yield curve shape and changes in it that will give you some sort of guidance to where markets are pricing in likely sort of recoveries and pace of that. So I think that's well worth watching. And I think the other big challenge for treasurers is how you dissect the economic data, because there's no doubt with what the central banks and governments are doing, they are creating some distortion in figures, and it makes interpreting data particularly tricky. And it's going to be, I think, a while till we really get a better grasp of what the trends are.
Makes sense. Well, Michael, it's been a pleasure once again. Thank you for coming on the show. We look forward to having you back next month.
Thanks, Simon. Have a great